Which of the following factors can cause a leftward shift in the aggregate supply curve? A. A decrease in input prices. B. An increase in productivity. C. A natural disaster that reduces production capacity. D. Technological advancements. Answer: C. A natural disaster can reduce a country's productive capacity, causing the aggregate supply curve to shift to the left. Which of the following best describes the relationship between inflation and unemployment in the short run? A. Direct relationship. B. Inverse relationship. C. No relationship. D. Variable relationship depending on external factors. Answer: B. In the short run, there is typically an inverse relationship between inflation and unemployment, as described by the Phillips curve. What is the effect of an increase in the money supply on interest rates, according to the liquidity preference theory? A. Interest rates will rise. B. Interest rates will fall. C. Interest rates will remain unchanged. D. Interest rates will fluctuate unpredictably. Answer: B. According to the liquidity preference theory, an increase in the money supply reduces interest rates as more money becomes available for lending. Which of the following statements best describes crowding out? A. When private investment is reduced due to increased government borrowing. B. When public investment increases private sector productivity. C. When government spending directly increases private investment. D. When private investment grows faster than government spending. Answer: A. Crowding out occurs when increased government borrowing raises interest rates, making it more expensive for private firms to borrow and invest. Which of the following is a function of money? A. Medium of exchange. B. Store of value. C. Unit of account. D. All of the above. Answer: D. Money serves as a medium of exchange, a store of value, and a unit of account, making it an essential component of the economy. Which of the following is a characteristic of a perfectly competitive market? A. Barriers to entry. B. Differentiated products. C. Firms are price makers. D. Many buyers and sellers. Answer: D. A perfectly competitive market is characterized by many buyers and sellers, free entry and exit, and homogeneous products. Which of the following will likely cause the aggregate demand curve to shift to the left? A. An increase in consumer wealth. B. A decrease in interest rates. C. A decrease in government spending. D. An increase in net exports. Answer: C. A decrease in government spending reduces overall demand in the economy, shifting the aggregate demand curve to the left. Which of the following is an example of expansionary monetary policy? A. Raising the reserve requirement. B. Selling government bonds. C. Lowering the discount rate. D. Increasing taxes. Answer: C. Lowering the discount rate is an expansionary monetary policy action that encourages borrowing and increases the money supply. Which of the following best describes the term gross domestic product, GDP? A. The total value of goods produced by a country in a year. B. The total value of goods and services produced within a country's borders in a year. C. The total value of goods produced by a country's citizens in a year. D. The total income earned by a country's citizens in a year. Answer: B. GDP measures the market value of all final goods and services produced within a country in a specific period, typically a year. Which of the following describes a contractionary fiscal policy? A. An increase in government spending. B. A decrease in taxes. C. An increase in the money supply. D. A decrease in government spending. Answer D. Contractionary fiscal policy involves reducing government spending or increasing taxes to decrease aggregate demand and slow down economic activity. Which of the following is most likely to happen if a government imposes a price floor above the equilibrium price? A. A surplus will occur. B. A shortage will occur. C. Demand will increase. D. Supply will decrease. Answer A. A price floor above the equilibrium price leads to a surplus because the price is set higher than what consumers are willing to pay, leading to excess supply. Which of the following is a typical characteristic of a monopolistic market? A. Many sellers. B. Easy entry and exit. C. Single seller. D. Perfect information. Answer C. A monopoly is characterized by a single seller with significant control over the market, often leading to higher prices and less consumer choice. Which of the following factors does not affect the supply curve? A. Technology. B. Input prices. C. Consumer income. D. Number of sellers. Answer C. Consumer income affects the demand curve, not the supply curve. The supply curve is influenced by factors like technology, input prices, and the number of sellers. Which of the following is most likely to occur in a recession? A. Increased investment. B. Decreased unemployment. C. Decreased consumer spending. D. Increased production. Answer C. During a recession, economic activity slows down, leading to decreased consumer spending, higher unemployment, and reduced investment. Which of the following is the primary function of the central bank? A. Controlling inflation. B. Implementing fiscal policy. C. Regulating imports and exports. D. Managing the stock market. Answer A. The central bank's primary function is to manage monetary policy, including controlling inflation through interest rates and money supply management. Which of the following is an example of a public good? A. A private university. B. A highway. C. A movie ticket. D. A company stock. Answer B. Public goods are non-excludable and non-rivalrous, meaning they are available for everyone to use without depleting the resource, such as a highway. Which of the following is true about price elasticity of demand? A. It measures the responsiveness of quantity demanded to changes in price. B. It measures the responsiveness of supply to changes in price. C. It is always greater than 1. D. It does not affect total revenue. Answer A. Price elasticity of demand measures how much the quantity demanded of a good responds to changes in its price. Which of the following describes a progressive tax system? A. A tax system where everyone pays the same percentage of income. B. A tax system where the tax rate increases as income increases. C. A tax system where the tax rate decreases as income increases. D. A tax system where only consumption is taxed. Answer B. A progressive tax system imposes a higher tax rate on higher income earners, making it more equitable. Which of the following is a likely consequence of deflation? A. Increased consumer spending. B. Decreased real debt burden. C. Decreased business investment. D. Increased employment. Answer C. Deflation can lead to decreased business investment as falling prices reduce profits and create uncertainty about future economic conditions. Which of the following best describes the invisible hand in a market economy? A. Government intervention in the economy. B. The self-regulating nature of the market. C. Central planning of the economy. D. Regulation of monopolies. Answer B. The invisible hand is a concept introduced by Adam Smith, referring to the self-regulating nature of the free market where individual self-interest drives economic efficiency. Which of the following does not shift the aggregate demand curve? A. Changes in consumer confidence. B. Changes in government spending. C. Changes in the price level. D. Changes in taxes. Answer: C. Changes in the price level cause movements along the aggregate demand curve rather than shifting the curve itself. Which of the following is likely to increase aggregate demand? A. A decrease in consumer confidence. B. An increase in interest rates. C. An increase in government spending. D. A decrease in exports. Answer: C. Government spending directly increases aggregate demand by boosting overall expenditures in the economy. Which of the following statements is true about fiscal policy? A. Fiscal policy involves changes in the money supply. B. Fiscal policy involves changes in government spending and taxation. C. Fiscal policy is implemented by central banks. D. Fiscal policy does not affect aggregate demand. Answer: B. Fiscal policy refers to government actions involving spending and taxation to influence the economy. The multiplier effect refers to A. The increase in total income arising from an increase in government spending. B. The reduction in aggregate demand due to higher taxes. C. The proportional increase in output resulting from an increase in investment. D. The increase in consumption due to a decrease in the interest rate. Answer: A. The multiplier effect explains how an initial increase in spending, example, government spending, leads to a greater overall increase in national income. Which of the following would cause the aggregate supply curve to shift to the right? A. An increase in the price of oil. B. An increase in wages. C. Technological advancements. D. Increased regulation by the government. Answer: C. Technological advancements improve productivity, increasing aggregate supply and shifting the curve to the right. An expansionary fiscal policy is most likely to involve A. An increase in government spending. B. An increase in interest rates. C. A decrease in the money supply. D. An increase in taxes. Answer: A. Expansionary fiscal policy typically includes increased government spending and/or tax cuts to boost economic activity. Which of the following is a primary goal of monetary policy? A. Achieving full employment. B. Reducing the federal deficit. C. Increasing government spending. D. Ensuring a balanced budget. Answer: A. One of the main goals of monetary policy is to achieve full employment by managing interest rates and influencing the money supply. Which of the following is an example of a contractionary monetary policy? A. Lowering the reserve requirement for banks. B. Increasing government spending. C. Raising the interest rate. D. Cutting taxes. Answer: C. Raising the interest rate reduces the money supply and slows economic activity, which is a contractionary monetary policy. Which of the following best describes stagflation? A. High inflation and low unemployment. B. Low inflation and low unemployment. C. High inflation and high unemployment. D. Low inflation and high unemployment. Answer: C. Stagflation is a situation where an economy experiences both high inflation and high unemployment simultaneously, which is challenging to address with standard economic policies. Which of the following is a public good? A. A pair of shoes. B. National defense. C. A hamburger. D. A toll road. Answer: B. Public goods are non-excludable and non-rivalrous, meaning they can be used by everyone, such as national defense.